Hello, everybody. Welcome to the Main Street Money Podcast, where Wall Street meets Main Street. I'm Andrew Gate, along with Zachary Green and Gilbert Pies. Together, we are the Texas Hill Country Advisors, an independent wealth management firm based here in the beautiful Texas Hill Country. We're going to talk to you a little bit about what's going on in markets and some of our perspective and compare how 2026 feels to 2022. Before we get started, a couple of quick mentions to set the stage for us here. If we're looking at the stock market, this is the fifth straight week of losses for the S&P. It's the longest losing streak since 2022. Oil's back above $110 a barrel. Treasury yields hit a 9-month high. I think we were talking before this started. The 10-year U.S. Treasury yield is trying to make its way to 4.5. Here's the one thing that should really get your attention. It's the market own forecast tool, the CME Fed Watch tool, which we talk about and reference on here quite frequently, is now showing a 60% chance of no rate cuts at all this year and a 31% chance that the Fed's next move is actually a rate hike. We're going to break it all down for you today in plain language, what it means for you and your money and how you should be thinking about this as an investor. A couple of weeks ago, we were talking about 2 cuts that were priced into markets with the same CME Group Fed Watch tool between now and the end of the year. But now we're at 0. And this morning, Zach and I were looking at it, and there's 2 new probability bars on the right side of the main one that says it's not expecting any cuts this year, which those represent potential hikes between now and the end of the year. It's not a secret that all of this is pretty much due to the price in oil. So quite the shift that we've had in the last couple of weeks in financial markets. And of course, as these rate expectations shift, we can see the movement in markets. We can see things like the stock market has been selling off with the idea that we might not see any rate cuts this year and potential rate hike. Higher oil prices mean higher inflation. Higher inflation means higher interest rates or fewer rate cuts than previously expected. That translates into higher borrowing costs and then ultimately potentially lower stock valuation. So that's kind of the chain reaction that is playing out in real time right now in financial markets. What's been your perspective so far, Gilbert? We're closing out the third month, the first quarter of 2026.
Yes, and we've got 5 straight weeks of lower stock market returns. All 3 major indexes are negative for the year. Not substantially at this point, but still negative for the year.
We're in correction territory, not necessarily bear market territory.
That's right. We've given up all the gains that we got the first couple of months of the year, given up all those gains and then some, and now we're negative across 3 major indexes. Not surprising that the Fed Watch tool is thinking that there could be a rate increase. It's the one thing I think that the Fed is very likely to do, raise interest rates if oil prices stay elevated for very long. Because oil prices bleed into everything that we do as consumers, as businesses. Oil prices bleed into everything. So higher costs for the producers is going to lead to higher costs for consumers. It's just the way it works. In fact, I don't know if any of y'all saw in the news this week, but FedEx announced a fuel surcharge on all their deliveries, and the U.S. Postal Service announced a fuel surcharge on all their deliveries. That's going to last for a while. And even if oil prices were to resolve themselves over the next 2 weeks, I don't think those fuel surcharges are going to resolve themselves. They're always really fast to implement them, but really slow to remove them. And I think all of this is going to be predicated on what happens with the war in Iran. Does it drag out for 6 months, 9 months, a year? Does it resolve itself in 6 weeks? I don't know. We're already, 6 weeks into it or 4 weeks into it?
Yeah.
I forget.
I think it's 4.
Yeah, 4 weeks into it. Well, guess what? The stock market's been going down for just as long, and you can tie the 2 directly together if you wanted to. It's a real easy correlation to make. So, and I think one of the reasons why we're seeing a big correction in the stock market is because the market was assuming 2 rate cuts before the end of the year, before the war started. Now that they're having to reevaluate that, there's been this huge repricing of risk and expected returns for the future. And that's why you're seeing the stock market say, hey, listen, the rosy picture we were painting for ourselves for the end of the year is now turned cloudy and gray and stormy. So we need to change our outlook. And if you look at the different sectors and the returns that are we're seeing right now, energy sector is doing the best by far. And the sectors that were doing really well last year, consumer or communications, telecommunications, and information technology, those are the two worst performing sectors so far this year. So not too big of a surprise, but it certainly is affecting everybody's idea about what they should be doing going forward.
And how do you think that this is similar to 2022? Because you and I we had Texas Hill Country Advisors, and I remember that January 1st, like it was yesterday. I mean, it was almost as soon as we flipped from the calendar year of 21 into 2022, the stock market just started selling off like immediately. And the expectation there was that the Fed was about to aggressively hike interest rates, which they did.
Which they did.
And it was kind of a fundamental restructuring of markets. That's not really what's going on this time around. Even though we're talking about the Fed might consider some potential rate hikes, it's just not the same thing, but it feels similar.
Yeah, I think really the similarities there are pretty straightforward. It's probably going to be a down year this year, probably. But keep in mind that things can change dramatically just as quickly as they turn negative. They can also turn around and switch positive, especially if the war gets resolved in the next few weeks. What that resolution looks like, I have no idea. And long term, who knows if it's going to be good or bad for us, them, our allies, who knows? But I would say that the market right now, today, if they had to stake their lives on it, are saying that the market's probably going to be negative this year. And so the market's just telling you that, okay, our expectations have changed. We're going to have a rough year. What I would tell investors, though, is what happened after 2022. That's really the thing you need to look at. What happens after the downturn?
Well, we've had 10+% positive gains.
That's exactly right
on the S&P 500.
That's exactly right. And I would tell you as an investor that you can't be focused on what's going to happen today, next week, next month, the next couple of months. What you need to focus on is what happens after the storm passes. Eventually, this too will pass. Every crisis that we've ever had in this country, whether it's economic, financial, or combination, or political, any of those things, eventually that storm passes. And when it does, we usually get this nice, sustained run up in the markets. And I think that's what you need to focus on as an investor, because if all you're doing is focused on, oh no, my returns are down, I'm negative this year, or I'm giving up my gains from the past 3 years, well, you kind of feel terrible about that. And I wish we could tell you when the storm's going to pass, but we can't. Nobody is smart enough to tell you when this thing is going to resolve itself, but it will resolve itself. Good, bad, or indifferent, it's going to resolve itself. And then what you'll see is the market recover, the economy recover, interest rates go back to more normal level, or the market starts expecting a more normal economy. And when that happens, because of the way our economy works and the growth engine that it is for the world, you will start seeing stock prices recover. And so you got to be setting the stage, and you like to say all the time, Andrew, planting seeds. You got to plant the seeds today if you want to see, nice crops in a couple of years. Yeah. And that might be how long it takes, but that nice crop might come in 6 months, 6 weeks. It might be a little while, but eventually, it's going to come. And I would tell people that that's really what you want to set yourself up for right now.
The other thing that I'm thinking about is I feel like we have a tendency as humans, just human nature, being human, to, I don't really know how to describe this, but it's kind of like not recognize things for what they are. Sometimes I think sometimes we have an issue with that. I think it's just built in and ingrained into being human. Our friends at Capital Group said they would not be surprised to see a correction in the market this year. We were talking about that 3-4 months ago at the end of last year. We get to the point that we're at now, and we're like, oh, war, geopolitical tensions, the oil price spike, all of that all of a sudden now feels bad right? We tend to think, well, this is different. Well, I would submit to you that it's really not, because we don't ever really know what the catalyst is going to be that causes markets to sell off, but we know that they do. So even though that it feels like, because every situation, even in 2022, I think people were thinking like, this is Armageddon. This is the first time interest rates are going up in 40 plus years like this. It's a completely restructuring of the fundamentals that financial markets have kind of predicated themselves on since after 08.
There was no place to hide in 22, just like 08.
But this is the thing, is what I'm getting at. Like, whatever this is, we didn't expect the Iran conflict to kick up and then oil, to spike in price and all these other things. But that is still baked into the idea of how markets work. And so as a long-term investor, knowing that those things are going to come around and that we go through cycles is part of it. But I think it's up to us as investors and to humans to recognize things for what they are when we're confronted with them, and not take the easy way out as to say, well, this is different. Like, yeah, I know markets go through cycles. I know we go through downtimes too. But then when we're going through a downtime, we make up this excuse about why it's Armageddon, and it's not the normal down cycle, that part of the cycle that we're used to seeing. And I'm here to tell you that no, this is definitely part of it.
It's the same thing. Exactly. What is it? Recency bias, I think, is what they call it.
Yeah.
As human beings, we tend to think that what's in front of us right now is exactly what it's going to be every single day afterwards.
Yeah. And it's the most true.
Yes. And as human beings, we tend to focus on the thing that's most present in our face right now, the day it happens. And we tend to assume that it's just going to be like this forever. Well, that's not true. What will happen is eventually this thing will get resolved one way or the other. I don't know which one it's going to be. It will get resolved. And as I've told people before, the cure for high oil prices is high oil prices, because eventually, as consumers, as nations, as businesses, we will look for alternatives to high oil prices. And there's a lot of pressure all over the place to reduce the price of oil. And so we wouldn't expect them to be this high for too long. But who knows? This time is different in that maybe the catalyst for the problem is different than what it was last time. But it is what it is, and it's just the issue today. And I would also tell you that it's not unusual for markets to have 10% corrections in a year, intra-year.
Yeah, think about COVID,
yes,
2020, right?
And then have a nice recovery at the end. Those things happen. It's not unusual to have 5%, even 10% pullbacks in the market during the year, only for it to end up at a different level. So I would not hit the panic button. I would not hit the eject button. I would not throw every caution to the wind and say, you know what, I'm just going to go head first. I wouldn't do that either. I think I would just be methodical and consistent and reevaluate what you're doing. And if things haven't really changed for you, then probably doing what you're doing is all you need to do. Easy to say, hard to do. We know that.
We like to think things are linear a lot of times. And even though our lived experience shows us different. I think about the chart that I have on my desk in there, and it's a really long track record of an all stock mutual fund, and the overall average annual return is like 11% or something like that. Great overall long-term average annual return. But if you look at the chart closely, you can see that the way that it was able to get that average annual return is by riding the waves of the market and having big up years, big down years, and everything in between. But over a very long term, the up markets outweigh a good bit in number the down markets or the down year. That's how you get a good average annual return, is by riding the wave and having the swings between up and downs and everything in between. Because if you look at that chart on a 1 year to year basis, there's almost no year that's 11%. Like that number doesn't really even exist on that chart. So it's not like it's linear where every year the market just goes up 7%. That's not how it works.
No. Yeah. And so I think what we're really saying is there's a lot of opportunity right now if you've got the stomach and the ability to be patient and wait for a recovery. It's coming. We know it is. We just don't know when. And if you've got the patience and the stomach to ride that roller coaster for a little bit, it's going to pay off very handsomely, most likely, depending on what you're doing. So we would submit to you that now's a great time. In fact, this is a great pitch for April the 15th. April the 15th is tax filing deadline. You have until April the 15th to make an IRA contribution. So if you don't have an IRA and you want to set one up, you can come visit with us. We can help set up an IRA for you, and you can make a contribution for 2025, right? In 2026.
Yeah, if you haven't filed yet.
If you haven't filed yet. Yes. And if you have filed yet and you want to get started in advance, you can set up an IRA for 2026, make your contribution right now. We can help you set up monthly contributions, quarterly contributions. We can help you get to where you want to be to take advantage of the pullback in stock prices.
Yeah, and we can give you some suggestions on maybe how much you should be saving to reach your retirement goal. LeCondre, welcome. LeCondre is a student at Schreiner and is hanging out with us for a couple of months to get some lived experience of what it's like to be inside of a wealth management firm. So maybe if you two guys want to talk a little bit about what your experience has been so far this year, watching the stock market kind of sell off. I know, Zach, we were talking that, you're licensed and dangerous and have been in the game for a little while now, but you weren't around in 2022. So you didn't really see that or know what it felt like as an advisor. So what do y'all want to opine on what we got going on here?
This kind of sucks. I thought the market was going to go up forever since I joined. I thought I was the lucky charm.
You thought it was going to go up 7% every year. Yeah, right. Okay.
I was going to straighten the line out for everybody. I guess not. But no, I think this has been a good learning moment for me, and the importance of $1 cost averaging is a big one, and actually putting that in my brain of how it's finally like very, very important, especially for accumulators in this phase, to continue to have a consistent purchase through these dips, through the waves up, and smooth out the ride. And one of my favorite things I've been seeing on social media, I know we bash on finfluencers a lot, but I'm not quoting finfluencers, but I see like finance people, and they're talking about people that are freaking out all the time about, oh, we're down 4% this year or whatever. And they always say, zoom the chart out, bro. And it's like, look at the 10-year, look at the long term, because that's what we're in here for. So
yeah, it's like
a good time to zoom the chart out.
Yeah, good.
I like that. I like that. Yeah.
Because when you do that and you see the dip that we've gone through in the first 3 months of this year on a 10-year chart, it's like just a little bitty,
it's like a blip.
Little bitty notch. It is
little buying opportunity.
It just doesn't, but it doesn't feel like a blip when you're in
no.
Right?
It feels like this. It feels like this one's different, and it's different because now it's affecting me more. So it has to be different.
Yeah, because if you had $100,000 invested and it's down 4%. You're down to 96,000, and you're probably scratching your head saying, "Hey, wait a minute! I thought it was supposed to go up. Now I'm losing money." Well, you haven't really lost until you sold, right? You haven't locked in any losses until you sell. As long as you're still invested, you have the opportunity to recover that and then some. But when you're sitting there looking at your statement and it's less than what you started with, yeah, I can understand. As a new investor, perhaps you would sit there saying, "Hey, man, why am I doing this?" Well, you're doing it not for today, not for tomorrow. You're doing it for next year, 2 years, 3 years down the road. That's when you're going to see it really, really pay off.
Yes, absolutely. You throw some
Dre. What's your take been on 2026 so far?
I feel like there's always going to be some downs in the years, or just some things that just doesn't look good. But I would say just keep going with it, and then at some point it's gonna go up, and it's gonna all compound together. So even though it looks bad, it feels bad. You just gotta kind of ride with it.
Like he's learning.
That's exactly right.
You're such a fast learner.
That's exactly what we would tell people. It when you're in that roller coaster ride, as you're going down that steep drop, man, you feel it in your stomach. Some people throw up. A lot of people scream and yell. It can really affect you, right?
Mm-hmm.
But when that thing levels out, you're like, oh, this ain't so bad. This is just fun. Yeah.
Yeah.
But when that thing's going up the hill, you're like, oh man, this is so awesome. But you know what's coming on the other side.
Mm-hmm.
You're gonna do some more screaming and probably throwing up again. But it'll all settle down, and then eventually the ride stops, and you're like, oh, okay, that wasn't so bad.
Yeah.
and then you've got that what is it, adrenaline flowing through your system, and you're like, oh man, I can fight a bear right now.
Yeah.
Afterwards. Now I wouldn't necessarily recommend you do that, but you can feel the exhilaration.
Mm-hmm.
It feels fantastic, but it can also be a little scary, and so you just got to be patient. And I know people this week we've gotten a few emailed inquiries, we've got a few phone calls. I had dinner and lunch with a couple of people this week. Everybody was asking about, what should I do? And we told every single one of them, what should you do? Nothing. Be patient. The way we have your portfolio set up is set up in a way that it can sustain you through this storm. And when things recover, which they will, you will be in a great position to recover. Because all of your investments, most of the investments anyway that we were in with these folks, they either pay dividends and interest. And for most of those people, we're reinvesting dividends. Well, when you reinvest dividends, back to your compounding analogy, you're buying more shares of your investment.
Mm-hmm.
And as the price goes down, because the stock market's going down, you buy more shares. And so when there's a recovery that happens, the recovery comes a little quicker for you, and you've got more shares to participate in that recovery too. So it's a win-win situation. The thing is, you just have to be patient and wait for it to recover. And I've said it once, I'll say it again. We don't know when that time's going to be. We just don't know, but we know it'll come, because it always has, and it always will. So you just got to be patient. And I think it's a great opportunity. Like I was saying earlier with the IRA contributions, if you haven't contributed to your IRA, do it. This is a great time. And just because you contribute to the IRA doesn't mean you have to purchase right away. You can set up, like Zach, you said earlier, a dollar cost averaging program. Maybe you put in $8,000 and we invest $1,000 a month for you systematically. Maybe you say, you know what, I don't want to do all $8,000 up front. Just take out $1,000 or $500 from my bank account every month. Great, we can do that too. There's a way to do it, but you got to start, and it's got to be consistent, and you got to be able to understand that things will get better.
Amen. They will. And I think it's a great note to close out on. So thank you guys for tuning in. A couple of quick notes not to pound a dead horse, but I'm going to wrap this up real quick. And please, if you have any questions about what you're doing in your financial picture, or you have friends that you think could benefit from a conversation with us, please feel free to refer us or reach out to us. We'd be happy to talk. So 5 down weeks, oil near $110 a barrel. The Federal Reserve may actually be hiking next moves. It's a lot to process, but here's the thing about moments like this. We've said it multiple times already on this episode, but they are temporary. Every difficult stretch in market history has ended. The investors who do best are the ones who stay informed, stay disciplined, and do not make permanent decisions based on temporary fear. We'll be back next week with a jobs report and more to report to you guys as always. So take care. Have a good weekend. We'll catch you next time. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.